Lesson number 13, Health Savings Accounts, HSAs. Hi, it's Mike. How are you doing today? I hope you're doing well. Thank you for coming by, and it's good to see you again. Today's lesson is about health savings accounts. We're just going to go into them at a very basic level. Health savings accounts are fundamentally used to save money for future medical expenses. That's all they're used for. Health savings accounts are like personal savings accounts, but the money in them is used to pay for healthcare expenses. You, not the insurance company, the government, or your employer, own the money in this account. The money you deposit into your health savings account is not taxed. To be eligible to open a health savings account, you must have a special type of health insurance called a high deductible plan. High deductible plans we'll go into in the next lesson because they do have a certain level of complexity, and I want to go over them in some detail in the next lesson. HSAs and high deductible health plans were created as a way to help control healthcare costs and to give more freedom to people as to how they spent their healthcare dollars. Like any other healthcare option, HSAs have advantages and disadvantages. As you weigh your options, think about your budget. Really think closely, especially with HSAs and high deductible health plans. And what healthcare costs do you think that you're going to need in that coming year? Remember, they're done in calendar years, which means January to December. If you're generally healthy and you want to save for future healthcare expenses, an HSA might be an attractive choice for you. Or if you're near retirement, an HSA can definitely make sense because the money in HSA can be used to offset costs of medical care that you will receive after retirement. But on the other hand, if you think that you're going to have a high cost medical procedure done, or you're going to run into a situation where high cost medical care will be needed, you will first have to meet the high deductible imposed by the high deductible health plan, and an HSA in that instance might not be your best option. Here are some basic points about HSAs. 1. You decide how much money to set aside for healthcare costs. Remember, there are limits in a given calendar year. We'll discuss those later. 2. You control how your HSA money is spent. You can shop around for care based on quality and cost. That's a major benefit, a very, very major benefit. 3. Your employer may even contribute to your HSA, which is even better. But you own the account, and whatever money has been put in there, either by you or the employer, is yours, even if you change jobs. Number 4. Any unused money at the end of the year rolls over, stays into your account to the next year. 5. You don't pay taxes on money going into your HSA. 6. Illnesses can be unpredictable, making it hard to accurately budget for healthcare costs. 7. Information about the cost and quality of medical care can be quite difficult to find. 8. Some older people find it challenging to set money aside to put into their HSAs. People who are older and sicker may not be able to save as much money as younger, healthier people. Keep that in mind. Your age at the time that you set up your HSA will be a factor, so keep that in mind. Some additional points. There's pressure to save money, because an HSA depends on you funding it. Nobody outside of your employer is going to put money in there for you, or is allowed to, I'll put it that way. So you have to think about how much money you want to fund this plan with. In addition, if you take money out of your HSA for non-medical expenses, you will have to pay taxes on it. You can start an HSA in one of two ways. 1, your employer may offer an HSA option where you work, or you can go and start an account on your own through a bank or other financial institution. Many banks have HSAs, so you can go to your local bank and ask them about it. But keep in mind, to qualify, you must be under 65 and carry a high deductible health insurance plan. High deductible health insurance plans are classified by the IRS and as having certain guidelines. We'll talk about that in the next lesson. If you have a spouse who uses your insurance as secondary coverage, he or she must also be enrolled in a high deductible plan. That's something to keep in mind. Please keep that in mind, because what can happen is that if there are, during the course of a given calendar year, if you both have healthcare situations where you have to use that high deductible plan, you'll be incurring a lot of money in deductible costs, a lot of out-of-pocket patient expense. So always keep that in mind. The high deductible plan must be your only health insurance. you can't be covered by any other health insurance. However, having dental, vision, disability, or long-term care insurance doesn't disqualify you from having an HSA. As its name implies, it's a health insurance plan that has a high deductible. The amount of medical expenses you must pay each year before coverage kicks in. You can go to some of our previous lessons where we talk about deductibles. Deductibles must be met before the insurer starts to pay on claims. Always keep that in mind. While the deductible is high with this type of plan, the premium, that's the fee you pay to obtain coverage, is typically lower for high deductible plans than for traditional plans. That's HMOs and PPOs and the like. High deductible plans don't start paying until you've spent at least $1,300 for an individual or $2,600 for a family of your own money on healthcare expenses. You can use your HSA to pay deductible expenses as well as co-pays and other non-covered healthcare expenses. Once again, I'll say it again, please understand how much you want to fund your HSA each and every calendar year. Make sure you stick to it, make sure you stay with it, and make sure that you understand how high deductible health plans work. That's the real secret. If you understand how high deductible health plans work, you'll be in great shape. Not all high deductible plans work the same. Some plans pay for preventative services such as mammograms before the deductible is met. You have to review the plan's coverage details. You have to review them and review them carefully, including the out-of-pocket maximum. Different plans have different setups with different things that they pay for and things that they don't pay for. Please keep that in mind. The Internal Revenue Service sets the contribution limits for HSAs. In recent years, the limits have been $3,350 for individuals, $6,650 for family coverage. If your employer offers a high deductible insurance plan, you may be able to deduct deposit money into your HSA on a pre-tax basis. If you open an HSA on your own, you can deduct your deposits when you file your income taxes. Remember, always know your financial setup and how you want to fund your HSA, and know the limits on your high deductible plan. If you do those two things, you'll find an HSA will be a very, very good option to have. It works out very well, but it's like anything else, like any other game, you have to know the rules. Yes, your employer can contribute to your HSA, but the total of your employer's contribution plus your contribution still must be within the contribution limits. So you can't go over the $3,350 if you're an individual, and you can't have $5,000 in it. That won't work. It must be $3,350 for an individual and $6,650 for a family. Now, it can be challenging, there's no doubt about that. But if you get an idea of your network, whatever insurance plan you go with, like we talked about before in previous lessons, please view previous lessons on our YouTube site. Please check and see what they pay for, what they don't pay for, how the deductible is distributed, and there will be other topics for you to review as well. One other thing I want to go over with you, and one last thing in closing. If you withdraw funds for non-medical expenses before you turn 65, you have to pay taxes on the money and a 20% penalty, okay? But if you take the money out after you turn 65, you don't have a penalty, but you must still pay taxes on the money, of course. Those are HSA basics for right now. Very, very basic concepts associated with these plans. You can, of course, go to your financial advisor or the bank or your employer, wherever you're going to go to set up your HSA, and they will give you greater details about how these plans work. That concludes this lesson for today. I hope that you learned something about HSAs today. As always, if you have any questions, you can email me or put a question in the comments. Thank you for your time, and if you've liked what you've heard so far, please subscribe, like, and comment. Take care and be well.